Spring has sprung and we are entering the spring selling season, and we just released our spring buyer's guide. And so I wanted to go over on the spring buyer's guide today the key points to help you understand what to look for in the market, where rates are, where affordability is at, where appreciation, like what are the key takeaways to help you buy that perfect home with that perfect mortgage plan in this buying season. All right, so the first thing we're going to talk about is mortgage rates hit a 3.5-year low this year. That's a big deal. And how that helps, just from a medium purchase price amount and median monthly payment, is about $300 a month. So that $300 a month created more affordability. And what that does is that opens the door for about 550,000 buyers nationally. And of course, we're the biggest state here in Texas. So that means over the next 12 to 18 months, there's going to be an additional demand going into the market. And let me tell you why that's sort of a key takeaway, because we haven't seen, they don't all move into the market right away. What happens is rates come down, people start to become aware things are more affordable, and then they slowly start to look and start that buying process, which is typically 12 to 18 months. So you have a window of getting out there and being able to buy a house with less competition. And that's really the key takeaway. If you're looking to purchase, you can buy a house with less competition this spring. So let's just take a quick look of how that affects your affordability. So at the height, rates were about 7.5. Now they're hovering around 6%. In some cases, we're actually seeing rates into the fives. Our rates are really good. We can get into the fives with a little bit of a buy down. But let's just say, for the sake of discussion, 6%. So at $250,000, look what happens. Difference between the savings on a $250,000 house is $249 a month. At $450, it's $448 a month. At $650, it's $648 a month. At $850, it's $847. Those are some big numbers as far as monthly savings go between the rates at a high and the rates at a low. And so once again, that affordability front is something that people are not really aware of, because there's so much else going on in the news today that they're not focused like, hey, the affordability situation has improved greatly. And here's another graphic that shows, going into COVID, when we had like this extreme sellers boom, affordability went really high. And then what happened is so affordability, worsened, and then rates was spiked up. And you can see right here is really when rates spiked up. So you see sort of the COVID boom made it more affordable, fewer houses, and then boom, rates spike up, and we're now starting to see that come down. And that 30% of income or less is what's considered affordable. Really, it's 31% sustainable. That's what that line is right there. And you can see we're hitting that line. And the closer we get to that line, the more demand will go up. It'll drive demand for housing and then create more competition for you as a buyer. Now, some other good news is inventory is making a comeback. This is active listings January of each year, going back to 2017. And you can see sort of a healthier market. And then you see the COVID years when rates were so low that it pushed inventory really down. And then coming out of COVID, we've slowly recovered to where now we're almost back to where we started. And that's really good, because that means more choices for you. And with demand still relatively low, it's more of a balanced market. So you're able to negotiate with sellers in most cases. Or if it's a just listed home, and this is a key takeaway too. If it's a just listed home, you really like, the seller might not want to negotiate when they just list a house, but you won't be facing 50 other buyers. You might be facing one or two, and then it's easy to beat them out. And a growing portion of the country is getting back to normal. Inventory is expected to keep growing. So this chart just shows like all we need is another 10% in inventory, and we'll be back to that 2017 to 2019 levels, which was a very healthy and strong market. Another thing to put on your radar is considering new construction, and we represent probably about 75% of the builders. We are now a preferred lender. We have extraordinarily great pricing for our new construction, great programs that we're able to put together with builder incentives. And this is why it's so important. Builder incentives are at an all-time high. 65% of all builders are offering incentives to buyers to help with closing costs. You can use them for upgrades. You can use them to buy their mortgage rates lower. or you can take off the price, and about 36 are cutting prices. So really, when you add the 36 together with the 65, there's your 100%. So the reality of it is 100% of the builders are offering concessions. What's really happening is about 65% of people are taking them mostly to do closing costs and mortgage rates buy down, sort of a combination of that. And then some will just take it off the price. But either way, it's an extraordinarily great time to buy a new home. So sort of what's happened in the marketplace is after when rates spiked up to 7%, the first people to feel suffering was the realtors. So the realtors felt suffering, and they went through that. Then the lenders felt suffering because they had to learn to adapt to this new environment with lower demand. We had what's called overcapacity. We had way more people than necessary for the number of transactions out there. And then the builders have slowly, to where it's like they're turning the barrel now, and sales have been really slow for them. And so they have to sell homes. So because it costs them money to have those homes sitting there. So the way you sell homes is you offer massive incentives. So this is a sort of a great time to consider new construction and take advantage of some of those incentives. Last thing I want to cover today is the top 2 buyer mistakes. Talk a little about those. Top 2 are putting a pre-approval off and buying more house than you can afford. So let me go over both of those. So the first thing is the number one, I would say, mistake people make is not building a mortgage plan. And that's what I do. And so the distinction between a pre-approval and a mortgage plan is that a pre-approval, the lender will give you a pre-approval letter and typically email you or call you and say, hey, here's the payment, and here's how much you qualify for. Here's the approximate payment. Here's how much money you need out of pocket, and no other details. There's no strategy given. There's no feedback given. There's nothing. And what ends up happening is you don't feel really good or certain, and you feel uncertain, and you feel a lack of confidence and a lack of empowerment because all you know is that you're pre-approved a certain amount. A mortgage plan is a homeownership strategy. So we do a pre-approval, and what I do is I pre-underwrite the file. So I design all the surprises out up front. We make sure we understand and fully underwrite qualifying income, and then I build you a homeownership strategy with a total cost analysis that takes the lowest cost mortgage program that would work for you, whatever loan program would work for you best, on a cost basis based on your goals of target payment, and target cash to close, the cash you have to work with. And we show you different options to structure that to make sure you're getting the lowest cost and the highest equity. So you get an education, and you then become an empowered buyer that goes out and you have a negotiation strategy, you have a target purchase price range, and you know why you're doing it. So that's a huge mistake. And the second one is buying more house than they can afford. That is also because a lack of a mortgage plan. So the key thing, if you remember earlier in the video, I talked about the 31% of gross income as a sustainable housing payment. So the benchmark is 31% of your gross income is considered sustainable, 25% is conservative, and then anything over 31, the greater you get over 31, the more of a stretch and the more painful it will be. And I always make sure when I'm consulting with clients, we're having those discussions. So I had a client yesterday, their debt ratio was 23%, and they were worried about the payment. And I could confidently say they were underbuying the house, and so that the house they were buying was no concern at all. And once they understood that, they agreed. And with other people that, hey, I want to buy a $600,000 house, and they qualify, but their ratio is like 45%. And I tell those people, I'll do this for you, but know that you're going to be house poor and you're going to have a lot of pain in your stomach every month because you're overbuying the house. So those are two big things that we handle with a great mortgage plan. It's what I do. Please feel comfortable reaching out or referring your family and friends. I'll take great care of them. And I hope you have a great day. Take advantage of what you've learned here. Get out there, get your mortgage plan built, and then go find a great house. Have a great weekend.